It is a Tuesday morning in October. You are 41 years old. You have a wife, 2 kids, 7 and 9, a mortgage on a house you have been in for 3 years, and a job you have held for 6. You are, by every reasonable measure, doing fine.
At 6:14 a.m., you do not wake up. The ambulance arrives at 6:31. The paramedics work for 19 minutes. At 6:50 a.m., a doctor walks into a waiting room and says words your wife will remember for the rest of her life. In the United States, 102 million adults have no life insurance coverage at all. Another 50 million believe they are covered, but carry less than half of what their family would need to survive. This is not because people don't care. It is because nobody ever showed them what the difference actually looks like. This video does that. We are going to walk through every level of life insurance coverage, from nothing to the policies that make a Tuesday morning in October survivable for everyone you leave behind. By the end, you will know exactly where you stand, what it costs to fix it, and what to do first. You are 34 years old, healthy, you work in marketing, you make $68,000 a year, and your employer offers life insurance, but the premium comes out of your paycheck, and you opted out to keep the extra $24 a month. You have a partner, no kids yet, a car loan, rent. This feels reasonable. You are young. You have time. Now consider what happens when you do not wake up. Your partner is responsible for the funeral. The national average funeral cost in 2024 is $8,300. That comes due within 30 days. Your partner has $4,100 in savings. The car loan, $14,200 remaining, does not disappear because you did. Your income, $68,000 a year, is simply gone. There is no replacement, no bridge, no runway. At level 0, the people who love you most are left to figure out the financial consequences of losing you, while they are also trying to survive losing you. That is what no coverage looks like. Not an abstract risk, a specific set of bills arriving at the worst possible time. Same person, same age, same salary. This time, they opted in. $22 a month. A $250,000 20-year term life policy. Took 12 minutes to apply. No medical exam. Approved the same week. Same person, same age, same salary. This time, they opted in. $22 a month. A $250,000 20-year term life policy. Took 12 minutes to apply. No medical exam. Approved the same week. Now, consider the same Tuesday morning. The funeral? Covered. Completely. With $241,700 remaining. The car loan? Paid off in full before the end of the month. Your partner has a runway. Not forever, but enough. Enough to grieve without also panicking about rent. At level 1, $250,000 does not make your death financially painless. Nothing does. But it removes the immediate catastrophe. It buys the people you love the one thing they will desperately need: time. The cost of this protection, spread over a month, is less than a streaming subscription. You are now 41. You have a mortgage, 2 children, a partner who works part-time to cover school drop-offs and pickups. Your household income is $130,000. You are the primary earner. At this level, $250,000 is not enough. Here is the math. Your mortgage has $290,000 remaining. That alone exceeds your Level 1 policy. Add the cost of raising 2 children to 18, the USDA estimates $310,000 per child in today's dollars. Add your partner's reduced earning capacity during the years spent parenting. Add college. The real number your family needs is not $250,000. It is closer to $1 million. A $1 million 20-year term policy for a healthy 41-year-old costs approximately $58 a month. At Level 2, the mortgage is paid off. Your partner does not have to sell the house to survive. Your children's college funds are intact. Your partner has time, real time, to rebuild a career if they choose to. Your income is replaced. Not forever, but for long enough. At Level 2, your death is still a tragedy. It is no longer a financial one. At Level 3, life insurance is no longer just about replacing income. It becomes a wealth transfer tool. You are 48. Household income, $320,000. You have a business, an investment portfolio, and a life insurance stack that looks like this. A $2 million term policy covering income replacement through retirement. A $500,000 whole life policy with cash value that your estate will inherit tax-free. A disability rider that pays 60% of your income if illness prevents you from working, even if you survive. And a living benefit rider that allows early access to the death benefit if you are diagnosed with a terminal illness. Total cost? $340 a month. At this level, your death does not just protect your family, it funds the next generation. The estate pays no income tax on the death benefit. Your children inherit capital. The policy becomes an asset, not just a safety net. But here is the thing that even Level 3 people get wrong. The policy exists. The money still may not reach the right person. In the United States, over $1 billion in life insurance benefits goes unclaimed every year. Not because the policy's lapsed, because beneficiary designations were never updated after a divorce, because the named beneficiary died first and no contingent was named, because the policy was bought and filed in a drawer and never touched again. At this level, your death does not just protect your family, it funds the next generation. The estate pays no income tax on the death benefit. Your children inherit capital. The policy becomes an asset, not just a safety net. The policy is not the last step. Naming the right beneficiary, reviewing it every 2 years, and telling someone where to find it, that is the last step. So where are you? And what do you actually do next? There are 3 questions. Answer them honestly. Question 1. Does anyone rely on your income to survive? A partner? A child? A parent? If yes, you need life insurance. This is not optional. If no, a small final expense policy between $25,000 and $50,000 covers burial costs so that no one inherits that burden. That is your minimum. You may not need more right now. But review this every 2 years. Question 2. Do you have a mortgage, significant debt, or dependents under 18? If yes, your floor is 10 to 12 times your annual income in term life coverage. At $70,000 a year, that is a $700,000 to $840,000 policy. For a healthy person in their 30s or early 40s, this typically costs $40 to $80 a month. If no, 5 to 7 times income is sufficient as a starting point. A $250,000 to $500,000 20-year term covers most scenarios.
For a single person with dependents but no mortgage?
Question 3. Does your employer offer group life insurance? If yes, take it, but do not rely on it alone. Group policies typically cap at 1 to 2 times your salary. That is rarely enough. Use it as a base and buy supplemental term coverage independently to reach your target number. If no, an individual term policy is your first priority. Start with a 20-year term at 10 times your income. Review at every major life event.
One final thing that most people delay and should not. The best time to buy life insurance is always when you are young and healthy. A 35-year-old pays roughly half what a 45-year-old pays for the same policy. A 45-year-old pays roughly half what a 55-year-old pays. Every year you wait costs you, not in risk, but in premium. The policy gets more expensive the longer you are alive, because statistically, every year of life shortens the window insurers are pricing. The single most expensive life insurance decision most people make is waiting. Go back to that Tuesday morning in October. Same person, same age, same house, same family. This time, there is a $1 million term policy in place. The premium was $58 a month. It was set up on autopay and not thought about again for 3 years. The funeral is covered. The mortgage is paid. The children stay in their school, in their house, in the life that was built for them. Your partner has years, not weeks, to decide what comes next. The tragedy is still a tragedy. The difference is that the people you love do not also have to fight their way out of a financial disaster while they are still in shock. That is what life insurance actually does. Not a product, not a sales pitch. A decision you make once that runs quietly in the background and matters more than almost anything else in your financial life on the one day it is needed.